In this video, we're going to be going through standard deviation channels, what they are, how to use them, and how you can really understand them and utilize them to your trading advantage. So to get straight into it, on the left here, this is standard deviation on a chart. And basically, if you watch this channel before, again, you'll see this chart quite frequently. But on the right, you can see this is actually a standard deviation distribution. So we're going to go through this first because you really need to understand this to understand the chart. So again, this may have been even something you learned in school, may sound familiar when you hear standard deviation. So to get straight into it, what you can see down here is the 1 and the 1 on this side. What this basically tells us is this is the first deviation of the distribution. So that is your first deviation, that is your first deviation. So from a chart perspective, it's that line and that line. And then this area in between is this value here. So that's from the standard deviation distribution to the standard deviation channels. Now, what does this all mean though? So what you can see is within this area, it says 68.2%. What does this mean? This means that 68.2% of the data is this, basically this value here. 68.2% of the data will be within this area here. So again, what this basically means from our chart perspective is that 68.2% of the data should trade, and we can actually change this to purple to make it a bit clearer, that 68.2% of the data should trade within this area here. Now, what we can see is if we go further out, here we have the 95.4% of data. So when we normally talk about this, we just say 95%. 95% of the data trades within this range. Now, what range is this? This is our second deviation. So now it doesn't just include the area that we were talking about with our first deviation, but it also includes this area to do with our second deviation. So now what this is saying is that 95.4% of data trades all within this area here. So again, what does this mean from a chart perspective? So it means that, again, this blue line here, this is our second deviation. So it means that 95.4% of data should trade within this line to this line. So again, now 95.4% of data should trade within this area here. Now on to the final deviation that we have on a distribution. That is our third deviations. So again, we have that there. That includes all the data we talked about previously. It includes the first deviation, it includes the second deviation, and now obviously it includes that third deviation as well. And this should have 99.7% of data. And when we say should have, if you're looking at an actual standard deviation distribution, as in this case here, when you're looking at this, if you got data in an Excel sheet, that will be accurate. It will be 99.7% of the data. But from a trading perspective, nothing is going to be 99.7% accurate. So again, there is going to be a little bit of change. But what it does mean is around, near enough, 99.7% of data should trade within our third deviation. And what is that from the chart? That is going to be this green line to this green line. So again, 99.7% of data should trade within this area here. So now we've gone through what standard deviation is, what it looks like on the chart. Now we're going to break this down a bit further. And again, we do have a red line here. You can kind of ignore this. This is a fourth deviation, not actually really looked at when you look at standard deviation distributions. It's more something I have on the chart just in case a stock is breaking out. This kind of just gives me that next level of a target. But again, we're not really going to cover it. You don't need to know it to understand standard deviation. And again, we're probably never going to trade off that level anyway. So now we've gone through everything. We've got our first deviations there. We've got our second deviations here. And we've got our third deviations there. So we've got our first, second, and third deviations. What do we do with these? What do these mean? So to cover how I personally look at this, and again, if you've been watching the analysis videos on this channel, this should make everything a lot clearer. So we can see that our first deviation is this range here. And so what this really means to me, first deviation's not something I really look to trade off. And the reason for that is a large majority of data can trade within it, but it can also trade with it outside of it. Again, we said 68% of the data trades within here, but that means 30% or 32% of the data trades outside of there. So knowing that, Do I really want to be shorting this level and buying this level? Not particularly. Yes, you should have more than a 50% win rate, but we can get a better probability looking somewhere else. Now, this isn't to say we will never use at this level. For example, we are looking at SPY, so the S&P 500 ETF, and considering that it's such a broad amount of stocks, it tends to actually respect these levels a lot better. So if I'm looking at trading or investing in the S&P, then these levels are going to be key. Because again, the majority of the trader does trade within this. And you can see this just looking here. We barely break outside of this range at all. So considering that, if I'm looking at investing, for example, I want to be buying our first deviation. If we ended up breaking that, I'm then looking at my second and third. So I will be looking at it like that. So that would be how I'd be looking at it as an investment standpoint. And again, let's say I've been holding it for a year. We may want to do a bit of repositioning on our investment as we're coming into our first deviation resistance, our second deviation resistance, or our third deviation resistance. Don't think I've ever really seen the S&P get there, apart from there's a massive kind of event. But if you're coming into that first or second deviation, it can be a good idea to potentially be locking in profits. Repositioning, again, take some money out of the market, and as we start to pull back, because again, if you're coming into here, you're going to be near those 52 weeks, or if not, all-time highs. So maybe locking in some profits here on your investment account, and then as it starts to pull back, getting more size in can be a smart way of potentially looking at investing. And then again, it doesn't require you to be looking at 100 different stocks, trying to pick the best stocks to be investing in. You can literally still just hold the S&P 500, but again, maybe just repositioning in a bit of a smarter way instead of just holding till retirement. And again, that's not to say that's a bad way of doing it. If you don't really like trading the market, that is obviously better than doing anything else, and probably better than giving your money to any sort of money manager. So that's how we look at it from an investment standpoint, but how do we look at it from a trading standpoint? And for this, I think we'll probably be better off looking at a stock. So we're going to go through one now because it hasn't fully played out yet. And that's going to be T-Mobile, ticker TMUS. And this one's quite key because I've actually invested in this one myself now. And why did I start to invest in it? Look where we came down. So price is trading within our first deviation. So again, 68% of the data should trade within that area, which, I mean, from this chart, looks pretty accurate. It would say a tiny bit over half is trading in this area. Now, what happens at this second deviation? We know that 95% of data should trade within this area. So we can see we trade out there, slightly there, a bit of time there, a tiny bit of time there, a tiny bit of time there, and now we currently just broken below it again now. So what this tells us is, again, that's probably actually a bit more than 5%, but again, like we said, nothing in the stock market is going to be 100% accurate. But it does give us a good sign that if a stock ends up going down to that low, we're likely to get a bounce. If the stock goes to that high, we're likely to start pulling back. So, oh, and actually, when we're talking about the 5%, it's actually the value below. So it should be that bit, that bit, that bit, and actually that bit. So actually, that is quite close to 5%. So what we can actually see is we get a good idea that if a stock, in this case T-Mobile, breaks down to its second deviations, that can be a good buying or shorting opportunity. And again, we can see the first time we actually hit that second, we got that bounce, which would have been a fine trading opportunity. Now, to cover the third deviation, we can see we haven't actually hit it to the upside at all in the last 6 months. Again, this is a 6-month chart. But we can see this downside third deviation has been hit. We can see that right now we have just hit it. It was at $128.50. And what happened as soon as we hit this level? We came down to here. And again, only 0.3% of the data or of the chart should be outside of that data. And again, that kind of looks like 0.3%, if not maybe a bit less. It was basically half a trading day. Or, sorry, less than 4 hours on a 6-month chart was outside of that third deviation, or at least so far. You never know, we might come back down and go back into that range, but as of right now, we came into that range, instantly got a bounce. So again, from a trading perspective, this is, and me being a reversal trader, to me, I'm really trying to get long bias here, looking to play that bounce basically to our main target, which is going to be this value here. I don't think we've actually covered this line yet. This dashed line here is our statistical mean. You can see it's between the first deviations either side. This is what you consider basically a fair value on the stock. If you're investing, you want to never really be buying above this level. You always want to be buying below, because again, this is fair value, or basically the average value throughout the year. You really kind of want to be buying below that from an investment standpoint, because again, we can be a bit more patient. But again, from that trading perspective, if we're looking to get long at our third deviation, we do expect it to overall reverse to our statistical mean, which, would be all the way at $144. Not to say we're going to hold it that whole way. Again, we're traders, or if we're looking at it from a trading perspective, we're getting long in this area here. We want to lock in profits as we come into our next resistance. That's going to be our third deviation. At least we move our stop to break even. Then we can look and continue the trade if we want to. So again, we move our stop to break even. Let's say our average is there. Now that's where our stop is. We've locked in some profits. Let's say we were long 100 shares. We probably close, say, 30 here. So now we're holding 70 potentially to our next resistance. In this case, we would be looking at this level here, and usually here I'd say then close out probably another 50. So then we would be left with around 20 shares, which again then I may potentially hold to that final target, that statistical mean at $144. And then again, once we hit this level, I never look to hold anything through this level, because we said this is essentially fair value. So if I'm a reversal trader, I want to be trading to that value. Once we go above that level, then I expect it to kind of start pulling back if I'm looking at it from a reversal standpoint. So again, that's firstly how I would look to invest, how I would look to play them as reversals. Now, what happens if you're a trend trader? Because you will use these levels a bit differently. So again, always be paying attention coming into these levels. That doesn't change, but it's how you utilize these levels will be a bit different. So as a trend trader, again, you see it kind of trading within this range. You're waiting for a breakout. What we can see is obviously we broke to the downside now. And what happened? We hit our second deviation. Again, if we were a reversal trader, we're getting along that. But if we're a trend trader, we're not touching that. What we're waiting for is a pullback. And that's exactly what we get here. And we'll zoom in to make this even more clear. It's the pullbacks that we want to be paying attention to. So the pullback, we retest our first deviation, and if that holds as a new resistance, then again, that's where we want to be looking at it. Short bias, potentially getting short there, and playing that continuation down to the downside. And again, would be the same thing to the upside. We break above our first deviation. You can see we kind of test our second deviation as a resistance. We come back, we test this area as a support, and we get a bit of a bounce. So if you're a trend trader, that's probably how I would look more to do them. And the last thing to cover, which should actually be quite self-explanatory, but it's kind of the same as a reversal trader, and that's if you're a range-bound trader, again, probably just be looking to short these areas, or again, if you want to do the second deviations, if you want a higher probability and higher success rate, we look to buy the second deviations, and we look to play them into either our next target or into our statistical mean. So I think that's quite a good breakdown on what standard deviation is, how to use them on a chart, and everything like that. One last thing we'll go through is just how to put them on your chart in case you don't already know. All you have to do is search for standard dev channel. And again, this is on Thinkorswim. Then what you can do is you click the kind of gears icon. And now what this will do is this will plot you a second deviation. So if you want your charts like mine, excluding this fourth one, you would add it once. You would put one there. You can change the upper and lower line. So this would be golden in my case. That would be our first deviation. So you can see that would match what we actually already have. Then what you can do is you need to add 2 more of these. So again, you would add 2 more. The second one you put as 2 deviations, it will be that by default. So again, then you can change your color. So you would change this to blue as if you want it the same as mine. And then going on to the final one, this we would change to the third deviation. And in this case, I have mine as green. And then what it would look like is basically how my chart already does. And again, one final thing, if you want to change the look of that statistical mean value, you go click middle line, and then you go style, And what you would want to do is select any of these that you like the look of. So for example, we could do that one. And again, you can change the color. So I will change it to pink just so you can see it change. And now what will happen as well is you kind of have to do this on all the middle lines, because, or what you can actually do is just hide it on the others, because all of them has a middle line, because that doesn't change depending on your standard deviation channel. So now what you can see is if we get rid of my old ones, we now have the standard deviations, and for some reason it's not showing us our second one, so I probably made an error. You can see I hid the upper line by accident, so again we need to show that plot, and then we can actually disable the show plot on the middle line. So then we click OK, and now you can see everything looks as it did before. Again, the lines aren't as thick, I didn't change the width, but overall everything is the same. Statistical mean, first deviations, second deviations, and our final third deviations. So that is a complete and utter breakdown of standard deviation and standard deviation channels. If you enjoyed the video, why not drop a like and subscribe. If you think I missed anything out, let me know in the comments. And if you enjoyed this, you might enjoy my strategy video here.